Here's something that should be impossible not to profit from. Owning a toll road means your customers have no choice but to show up and pay you every single time. And yet, one company managed to lose $4 billion doing exactly that. By the time this video is over, you will understand exactly how you lose money on a toll road and why that same business model made someone else $30 billion from the exact same idea. What are you actually buying? You are not really buying a road, you are buying a concession. That is a legal agreement, usually with a government, that gives you the right to operate a specific stretch of highway and collect tolls from its users for a fixed period of time. That period could be 25 years, 50 years, 75 years, or in some extreme cases, 99 years. When the concession expires, the road goes back to the government. You hand over the keys, and that is it. So you never actually own the land beneath the pavement. You own a time-limited right to extract revenue from the traffic flowing over it. Think of it like a very long-term lease on a river of cars. Toll roads come in several flavors, and each one is a fundamentally different business proposition. The first is a greenfield project. This is where you build a brand new road from scratch. You finance the construction, you take on the traffic risk, and you pray that enough drivers show up to justify the billions you just spent pouring concrete. The second is a brownfield acquisition. This is where the road already exists, traffic patterns are well established, and you are essentially buying a known cash flow stream at a negotiated price. Far less risky, far more expensive to acquire. The third model is what is called an availability payment concession. In this version, the government pays you a fixed annual fee regardless of how many cars use the road. You build it, you maintain it, and the government absorbs the traffic risk. This is the safest model for the operator, but also the least lucrative. But none of it gets built for free. Highway construction is measured in cost per lane mile, and the numbers vary wildly depending on where you are building. In a flat, rural area with cheap land and minimal environmental concerns, you might spend $5 to $10 million per lane mile. In a dense urban corridor where you need to acquire expensive property, relocate utilities, build overpasses, and comply with decades of environmental regulations, that number can explode to $50, $80, even over $100 million per lane mile. A major urban toll road project can easily cost $3 to $8 billion before a single car drives on it. The Indiana Toll Road, a 157-mile stretch across northern Indiana, was leased in 2006 for $3.8 billion. The Chicago Skyway, just 7.8 miles long, was leased for $1.83 billion. The 407 Express toll route in Toronto, which runs about 67 miles, was sold for $3.1 billion Canadian in 1999 and is now estimated to be worth well over $30 billion. That Toronto deal has been called one of the worst government asset sales in Canadian history and one of the best private infrastructure investments ever made, often in the same sentence. Same transaction, two completely opposite conclusions depending on which side of the table you are sitting on. So where does the money come from once the road is open? The revenue model for a toll road is deceptively simple. It is the toll rate multiplied by the number of vehicles, multiplied by 365 days a year, multiplied by the number of years in your concession. That is it, 4 variables. And every single strategic decision you make as an operator is designed to maximize one of those 4 numbers. The toll rate is the most visible lever. Many concession agreements include a formula that allows you to raise tolls annually, usually pegged to inflation or sometimes to GDP growth. This is critical because it means your revenue grows automatically over time without you having to do anything. In many concessions, you can raise tolls by the Consumer Price Index plus 1 or 2%. That does not sound like much in any given year, but compound that over a 50-year concession, and the toll that starts at $3 ends up at $15 or $20. The 407 in Toronto has become known for this. You can raise your price, but if you raise it too much, you push traffic onto the free alternative, and your volume drops. Volume is the second variable, and it's the one operators have the least control over. Traffic projections are the single most dangerous number in the entire business. When someone is trying to sell you a toll road concession, they hand you a traffic study. That study is produced by a consulting firm, and in some cases, the firm has been hired by the same entity trying to sell the concession. There is a term in the industry for this phenomenon. It is called optimism bias, a polite way of saying the forecasters told you what you wanted to hear. A landmark study looked at toll road traffic forecasts across dozens of projects worldwide and found that actual traffic in the first year was, on average, 20 to 30% below the forecast. Some roads came in at 50% below projections. When your entire financial model depends on a certain number of cars showing up every day, and half of them do not appear, you have a catastrophic problem. Your debt payments do not care that the traffic study was wrong. The interest is due regardless. Toll road cost structure runs counter to intuition. The biggest cost is not maintenance. It is not staffing. It is not even the toll collection technology. The biggest cost, by a massive margin, is debt service. Because toll roads cost billions to build, they are almost always financed with enormous amounts of borrowed money. A typical project might be 70 to 80% debt financed. On a $5 billion road, that means $3.5 to $4 billion in loans and bonds that need to be repaid with interest over the life of the concession. The interest rates on this debt depend on the risk profile of the project. A brownfield road with decades of traffic history might borrow at 4 to 5%. A greenfield project in an emerging market might pay 8 to 12%. At those numbers, debt service can consume 40 to 60% of your total revenue in the early years. You are collecting tolls from millions of cars, and more than half of that money is going straight to bondholders before you touch a cent. This is where a $4 billion loss starts. Maintenance is next. A highway does not just sit there being a highway. Asphalt degrades. Bridges need inspection and repair. Guardrails get destroyed. Lane markings fade. Drainage systems clog. A well-maintained toll road spends roughly 5 to 8% of its revenue on routine maintenance. But every 15 to 20 years, you hit what the industry calls a major life cycle event. That means resurfacing the entire road, rebuilding bridge decks, replacing signage and lighting systems. These periodic overhauls can cost hundreds of millions of dollars, and they have to be budgeted for from day one. Technology is next. The old model was toll booths with human collectors handing out change. That model is almost entirely dead now. Modern toll roads use electronic tolling, either through transponders mounted on windshields or through license plate recognition cameras. The technology is expensive to install and maintain, but it dramatically reduces operating costs compared to staffing hundreds of booths around the clock. But the technology needs constant upgrading. Systems installed 10 years ago are already outdated. Staffing, administration, insurance, legal costs, and the inevitable lawsuits round out the expense picture. Litigation comes from multiple directions. Property owners whose land was acquired through eminent domain sue over the valuation. Environmental groups sue over habitat disruption. Municipalities sue over traffic diversion onto local roads. Drivers sue over toll increases. The legal budget for a major toll road operator is a permanent line item, not an occasional expense. So after all of this, what kind of margins are we actually talking about? A mature, well-run toll road with established traffic and manageable debt can generate operating margins of 60 to 70%. But remember, a huge chunk of that operating profit goes to debt service. The net margin after debt payments in the early years of a concession might be 10 to 15%. As the debt gets paid down over the decades, the margins widen dramatically. The last 10 to 15 years of a long concession are often extraordinarily profitable because traffic has grown, tolls have increased with inflation, and the debt is largely retired. That is the golden period every toll road investor is trying to survive long enough to reach. But margins like that do not go unnoticed. Toll roads carry a distinct kind of political exposure. Drivers see the road, know their taxes helped fund the highway system, and bristle at a private company charging them to use what feels like a public asset. Governments face a fundamental tension with toll roads. They need the infrastructure, but often cannot afford to build it with public funds. Private toll road operators solve the funding problem by bringing in private capital. But the moment tolls start rising and a private company is visibly profiting from a public necessity, the political backlash begins. Concession agreements have been renegotiated, sometimes forcibly, in countries around the world. In some cases, governments have simply nationalized toll roads, paying the operator a fraction of the asset's value. This political risk is not theoretical. It is a core part of the investment calculus. When investors evaluate a toll road concession, they are not just modeling traffic and toll rates. They are assessing the stability of the political environment over a timeline measured in decades. Will the government that signed this agreement still honor it 20 years from now? Will public pressure force a renegotiation? This is the Indiana Toll Road. In 2006, the state leased this 157-mile highway to a consortium led by Sintra and Macquarie for $3.8 billion. The investors loaded the project with debt and built their financial model on traffic growth that never materialized. The 2008 financial crisis crushed traffic volumes. Trucks, which pay the highest tolls, disappeared as the economy contracted. By 2014, the operating company filed for bankruptcy. The lenders took massive losses. The road itself kept operating because highways do not just stop existing when their owners go broke, but the investors who had paid nearly $4 billion for the concession were essentially wiped out. Now the success story. The 407 ETR in Toronto is perhaps the single greatest toll road investment in history. The province of Ontario built the highway and then sold a 99-year lease in 1999 for $3.1 billion Canadian. The consortium that bought it, led by what eventually became part of the Spanish infrastructure giant Ferrovial, secured toll escalation provisions that allowed aggressive price increases. They invested in electronic tolling technology that eliminated booths entirely. Traffic grew steadily because Toronto kept expanding outward, and the 407 was the only viable alternative to the perpetually congested Highway 401. By the mid-2020s, the road was generating well over $1 billion in annual revenue. Its estimated value had grown to somewhere between $25 and $40 billion. $3 billion for an asset now worth 10 times that amount. The difference between the Indiana disaster and the Toronto gold mine comes down to three factors: traffic risk, debt levels, and the length of time you have for the math to play out. None of that requires you to personally raise $4 billion, though. Retail investors can buy into toll roads through infrastructure investment trusts, or INVITs, structures that pool investor capital, collect the tolls, pay the debt service, and pass what is left to unit holders. INVITs are well established in India, where several major trusts are built specifically around highway concessions. Yields typically run 8 to 12%. For institutional investors, toll roads have become a core holding in infrastructure portfolios. Pension funds are drawn to them because the cash flows are long duration, inflation-linked, and relatively uncorrelated with stock market movements. A toll road does not care whether tech stocks are crashing. People still need to drive to work. But there is a looming question for the toll road industry, and few operators are addressing it publicly. What happens to toll road economics when autonomous vehicles reshape transportation? What happens when remote work permanently reduces commuting volumes? These are not hypothetical scenarios for a 50-year concession signed today. They are questions about the middle decades of that concession, the exact years when the debt is supposed to be paid off and the golden period of profitability is supposed to begin. Some analysts argue autonomous vehicles will increase toll road usage, since self-driving cars will be optimized to take the fastest route. Others argue congestion pricing on free highways will blur the distinction entirely. Nobody actually knows, and that uncertainty gets priced into every new concession. Two toll roads, same business model, wildly different outcomes. Scenario 1. A mid-sized brownfield toll road. You acquire a 30-year concession on an existing 100-mile highway connecting two mid-sized cities. Purchase price, $2 billion. Annual traffic, about 40 million vehicle trips. Average toll, $4. Annual revenue, roughly $160 million. After operating costs of about $30 million and annual debt service of about $70 million, your free cash flow is approximately $60 million a year in year one. With toll escalation of 3% annually and modest traffic growth of 1% per year, by year 15, your revenue has nearly doubled and your debt is substantially reduced. By year 25, you are generating over $150 million in annual free cash flow. Total return over the life of the concession, somewhere around 3 to 4 times your equity investment. Scenario 2. A major greenfield urban expressway. You build a new 30-mile elevated toll road through a rapidly growing metropolitan area. Construction cost, $4 billion. You finance 75% with debt. Traffic projections suggest 60 million trips per year at an average toll of $6. But that traffic estimate might be wrong. If actual traffic comes in at even 20% below forecast, your revenue drops from $360 million to under $300 million, and your debt service does not budge. Suddenly, your margins are razor thin, and every unexpected maintenance expense becomes a crisis. If the projections are right, though, and the city keeps growing, then by year 20, this road is generating $500 million a year in revenue, with debt service that has been halved through repayment. Your equity returns would be extraordinary, 7, 8, maybe 10 times your initial investment. One is a bond with asphalt on it. The other is a debt-fueled bet on a city's future that could go either way. The revenue mechanism is nearly perfect. Captive customers, daily recurring demand, automatic inflation adjustments, a concession that lasts decades. But everything underneath that pristine revenue line is a battlefield. Construction overruns, traffic shortfalls, political interference, debt that does not forgive. So next time you are sitting in that line at the booth, ask yourself which one it is. Is the person collecting your $3 quietly getting rich, or trying to figure out how to make next month's bond payment? You have no way of knowing. Most of the time, neither do they, until it is too late.